Hi, I'm Paul Merriman, and if you're a first-time guest to our boot camp series, I want to take just a few minutes and talk about the purpose of this series because I do think it is the most important work that we do. Now, this presentation, stocks versus bonds, this is really the number one decision I'm talking about in terms of impact on your financial future. And so I want to make it very clear the implications that you might make about whether you invest in stocks or bonds. And then we'll have following series of presentations that will again address what I consider to be some of the most important investment decisions of your life. I mean, at some point, you're going to have to decide how to build a portfolio for your risk tolerance and your desire for return. How do you do that? How do you pick the mutual funds or ETFs to accomplish that? How do you think? How do you live and understand the process of accumulating money over a long period of time? Of these, I think, are really important decisions. But I do want to start from the ground up. And even though we have already recorded some of the later pieces, and you can go see them if you wish, this is truly the one that I think is number one. And so, as we get into what I consider to be the biggest decision you will ever make regarding investing, stocks versus bonds. And I have to assume that some of you are beginners. And so I don't want to leave you behind. I want you to be with us right from here on. In the beginning, this decision, stocks versus bonds, should be driven by the understanding of what stocks historically do and what bonds historically do. At age 81, I've got both stocks and bonds in my portfolio. Stocks for growth and bonds for income. But to understand the ownership of a bond or a bond fund, a stock or a stock fund, understand this. In the case of a bond, somebody is promising to borrow money from you, pay you interest, and pay you back the principal on that loan at some point in time. That's called the maturity. Sometimes people will loan money for 30 days. Sometimes people will loan money for 30 years. But you don't own any part of that company. Well, you might have a call on the company if they go into bankruptcy. And because you're a bondholder, you would be paid before the shareholders get anything, the stockholders. But the bottom line in most cases is that you are going to loan money, get a relatively low rate of return. And why will it be low? Because somebody is saying, I guarantee to pay you back a certain amount of money over a period of time, the interest, and then the principal. Now you compare that to the stock, where in essence, the sky's the limit. I was just looking at some historical returns of companies that are up 20,000% since they started some years ago. Others are worth nothing. And of course, therein lies the problem with stocks is they can virtually go to nothing. And some of the names that were at one time household names, like, well, let's see, uh, Washington Mutual would be one that would certainly come to mind. Enron, another one. Eastern Airlines, another one. At one time, profitable organizations, but in the end, the shareholders took the ultimate risk, losing everything. Of course, this is obviously the reason when you are going to invest in stocks, we want you to invest in a mutual fund, a whole broadly diversified portfolio. And we'll talk about that in a few minutes. But the key is with stocks, the sky's the limit. You could, if you invested all of your money in one company, make hundreds, thousands of times what you put into that company. And there are actually quite a few of them. If you look historically, about 1 out of 25 will have a great track record. The other 24 don't do that well. But when you put them all together, the good ones and the bad ones, you'll see in just a second that the long-term return has been, and we always have to say has been, because we can't buy the past and we can't know the future. But that owning all of them has given people a really fine return. So, what do we know about stocks? Lots of potential return. Bonds, small potential return, but the bonds are, at least on a short-term basis, very, very low risk. When you buy a 30-day T-bill, US government T-bill, I don't know what they're paying today, but let's say they're paying 4%. For 30 days, on an annualized basis, you will get that 4% and you'll get your money back. And that has never failed to happen since they started 100 years ago, plus paying and borrowing from the public and paying them back on a regular basis. If we ever stopped doing that, that would probably be a catastrophic event for our country. But bonds are very low, low, low risk on a short-term basis. Now, if you have longer-term bonds that mature in 30 years, they will be more volatile because bonds do go up and down depending on the direction of interest rates. And so while there's some volatility, I'll show you that volatility in just a minute, in the bonds, it's nothing like the volatility of stocks. With stocks, you could easily, when I say easily, it's happened a number of times that all stocks go down on average 50%. It happens. That is not true of bonds. The problem with bonds is that if we're building for a long period from now, putting money away for retirement, and you're just getting started, you don't want to have your investments in something that pays a very low return for a very long period of time. You don't need the money in the next year. You don't need the next money in decades. Maybe it'll be 4 decades before you'll need the money. So you have the good fortune of being able to take the volatility of the stock market. Now, at age 81, my wife and I only have half of our money in the stock market. The other half is in the bond market. So there's no recipe for everybody here, but we've got a pretty good idea of how young people should address the risk of stocks and bonds. And we have a pretty good idea of how older people should address that combination of stocks and bonds. They're both legitimate holdings. But boy, when you don't need safety for the short term, long term, then stocks are a way, way better decision. Let me show you some numbers. Now, I don't want to say I live and die with numbers, but I think people who know our work will say that we have more numbers than most. We want to see the evidence. We want to see the evidence from the past that doesn't just show what happened in the last 10 years or last 25 years. We want to go back as far as we can and believe that we're getting legitimate results of what the market was like then. So we have in this presentation a lot of information going all the way back to 1928. And I didn't dig that information out. That was the work of the academic community. They have the hordes of people theoretically available to help them dig out all this past. Now, I recently debated somebody who really he didn't make fun of me, but he was saying that all of this information from the past is not evidence, that it isn't something we should rely on. My problem is, I feel like I'm at a fork in the road. And that fork in the road is, do I trust a long history of results and see enough of the good and the bad times that I feel like I do truly have an idea of how this process is going to work out in the future that I can't know? So I could very Pollyanishly paint a picture of the future that it is absolutely fantastic. You are going to make so much money and it's going to be so easy. All you have to do is, well, the fact is, nobody knows the future. Nobody. But we do know the past. And what we're really concerned about, because we can't know how much we'll make in the future, we can believe wholeheartedly that over a long period of time, you will get a premium for the risk that you take today. If you do it right, by the way, you need to do it right. You need to be very prudent. You need to diversify, and low expenses are a whole bunch of things I want you to do. But the bottom line is the odds are it's going to work out for you. Now, if that's true, what I really need to understand is, what do the bad times look like? Because if I can get a sense that everything is likely to be okay for the long term, that whatever challenges we might have as a country right now, we've had similar, they never feel similar, by the way. I mean, try to make the case that what we're facing today is so tough compared to the Depression. I don't think the people who went through the Depression would equate the two. I think they would say the Depression was a much more difficult time than whatever it is we're going through in the US today. So I want to see the bad times. I want to know what it looked like in the bad times, because my belief, and it can only be a belief and nobody else can know any better, is the past will look like the future, I should say, will look like the past. If last year the market was up 25%, and it was, I'll bet you there are lots of times the market was up 25 to 30% in the past. And it's true. In fact, I'm going to give you the proof of that today. You can go through and look at how often the present looks like the past. What we can't know is what is called the sequence of events. I can tell you that the market has gone down 50% or more many times. I can even give you the dates, but I would never be able to tell you those dates in the future. I would only say, I believe if you put money away into the stock market today, that over the next 40 or 50 years, if that's what you have the good fortune to be able to appreciate and grow for you, that you'll probably have 2 or 3 times that the market will go down 50%, which is one of the reasons my wife and I have money in bonds for half of our portfolio. So enough of that talk. Let me take my little red ball here and walk you through 3 different levels of risk in bonds. One is called a short-term bond. In this particular case, these are 1-month bonds that you could loan to the government, get your money back, loan it to them again, get your money back, plus the interest. And just every month you continue to have this 1 month at a time, a loan and then repaid, for which you don't make much, because you can see that over the last 97 years, it has grown at 3.3%, which turned $100 into $2,286, assuming you left the money in there and it compounded. Money growing on money. So if it made 3.3% on $100, the next year If it was still paying 3.3%, it would earn 3.3% on $103.3, and it would keep building and building and building. Why is it so little money over